Welcome to Living Your Greatness. Each episode, we bring on great people to inspire you to achieve your greatness. We discuss topics all related to health and wellness. Listen to world-class stories, learn valuable lessons, and turn knowledge into action. It is now time for you to unlock your inner greatness. Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mummy, and today we have a new guest to the show, and his name is Brian Leni. For those of you who don't know Brian, he is the founder and editor of Junior Stock Review. Brian is actually an engineer by trade and worked in the steel industry for more than 10 years. Brian was immediately drawn to the junior sector for a variety of reasons, but most importantly, because of the incredible gains that could be made from these tiny resource stocks. Brian has perfected his craft as a successful junior resource sector investor and has supported his family from the profits that he makes through his investments. Brian's newsletter covers companies in the junior mining sector, along with completing interviews with some of the best industry leaders, such as the great Rick Rule. So Brian, welcome to the show.
Thanks for having me on, Ben.
So Brian, let's kind of get kicking here. Tell us more about your formative years growing up in Canada. What inspired you to start a newsletter business for investors speculating in the junior resource sector?
Sure. So I did engineering at university. Right out of school, I actually got a job with a company that I had interned with during a summer position. And I was actually in the pharmaceutical equipment genre. And it was actually quite an excellent job. It was a small company, like 20, 25 people. And the people that they hired were kind of jack of all trades. You worked on maintenance, on assembly, on customer calls, everything. And so it was a great experience for me to kind of learn everything. I worked on a CNC lathe, CNC mill, great experience for me. But at one point it was time to leave, and I actually got a job into steel. And so I started working for a Brazilian steel company, and I worked first as a process engineer on the floor, doing CapEx projects, efficiencies to the process line, working with the guys on the floor to make things better. From there, I did pretty well in that position, and I took a promotion into management and started overseeing, the process myself and different aspects of it. Along the way, I learned that managing people is much different than, technical pursuits, and that there was an aspect of it that I really didn't like. And that's probably innate to the, maybe the person that I am, which led me, to trying to find a way out. And invariably, along the way, I was investing in the market and made some pretty bold moves to put myself into a position to benefit from a market turn in sentiment. And this sort of coincided with this desire to leave. And that's what headed me towards, being a private investor. And the newsletter thing is something that's kind of like a side or bolt on to the whole process. Really, what I was trying to do was trying to get out of that lifestyle and to get into something more that suited me and my family. So that was like the kind of the gist of, or run up to becoming a private investor.
Yeah, thanks, Brian. Thanks for sharing that story about going from your true trade, I guess, where you were, and then making that transition once you saw that opportunity of the natural resource sector. So Brian, I actually want to go back a little bit in time here. In 2013, you made a pretty bold decision to sell your family's home and use 2/3 of the equity to invest in the best junior mining companies in the sector. A couple years later, I think it was in 2016, your portfolio had increased over 300%. It gave you the opportunity actually to leave your career as an engineer and pursue investing full time. What gave you such strong conviction to make this decision?
That's a really good question. Honestly, I do think it's the confluence of a number of things. I think first and foremost, it was the desire to get out of a situation that I didn't like. And that kind of reflects who I am as a person. And I've learned that more as I've gone along, being more self-aware. I'm an independent person. I believe in self-responsibility. And in reality, the people that I've met over the years, I'm a libertarian from, the core of who I am. And the process of working within a large corporation, dealing with a unionized workforce, really it was in complete opposite of who I was. And, I definitely felt trapped. At the same time, I was really interested in precious metals, and I had caught the bug of investing in junior companies. And with all that kind of coming together, and as you said, like in 2013, I said to myself, the market is kind of tanking, sentiment is horrible. If I really do believe in this, and buy when others are selling, this is the perfect opportunity. The problem I think with a lot of people is that the house is usually their biggest investment in their life, and all your capital or a lot of that money you're making on a month-to-month basis comes to servicing a mortgage. And I knew this, and I knew there was some equity built up in my house. It's interesting how the real estate market has kind of worked over the course of the last 50 years. But I thought to myself, wow, like the only way I'll actually be able to make a difference in my life is if I extract that equity and use that to potentially propel myself forward. It's the only kind of option I saw. Because the other way around, like I had made some doubles and triples, but like on a $1,000 or $2,000 position, it's great, but who cares? And I wanted to make a big impact, make a big change. And so with the full support of my wife, and I think that's, that was a huge part of it. She's always believed in me, and she fully supported the idea. So we sold the house, moved into a rental, and I took that equity, and over the next, like basically 2 years, I deployed it into what I thought were the best companies. And really in 2016, you saw this sentiment change, which, was the big deal. And I just happened to be in some of the companies that had the biggest change in share price. In retrospect, honestly, I look back onto the investor I was back then to who I am now and how I participated in the market. And I can 100% say that I confused a bull market with brains. And I think a lot of people need to take heed of what I just said, because it's so easy to get caught up in believing that all the answers or have all the answers and are proficient at something. But I'm telling you, you need to put 10,000 hours into something before you can become proficient, in my view anyways. And there's a lot that goes into it. And, if I were that same investor today, I probably would be back doing some engineering job, because a bear market will eat you up, and you need to be able to participate in whatever the market gives you. And, over my course of my career as an investor, I've been in more bear market portions of cycles than I have been in bulls. And I'm telling you, it's a completely different beast. And so you need to be anchored well and have, a set process that you look upon when you make decisions to kind of go forward. So conviction, I had a lot of conviction to a certain extent. But it was also mixed with a wanting to make a change in my life. And I'm very glad that I had that somewhat blind view to the risk, because it's made all the difference in my life. But in retrospect, wow, like that was even a bigger move than I even gave it credit for at the time. And but in retrospect, it was the right move.
Absolutely. And I want to applaud you actually on, having the guts to make that move. That was risky, but the biggest risk, if you've studied it and if you know it well, could also be the biggest reward. Eric Sprott always says, being at the party in the room alone before the whole party joins you is kind of the best thing that you can do if your conviction is so strong and that you know that you could strongly be right in terms of probability. So that's awesome. And it sounds like your wife was with you on there and she trusted you. And that is amazing to hear, especially when it comes to the stock market. Yeah. So transitioning from your story, going now to like the macro picture of what's going on right now, there's been a lot of talk right now about inflation. And, some of the government's been saying it's been transitory. Other people have been saying, no, it's going higher. And so last month, a billionaire investor, Ken Ligon, told CNBC that inflation is not transitory. He expects higher than usual inflation to hit the US economy. So what do you think, Brian? Is inflation transitory, as the Federal Reserve makes us believe?
It's a great question. I think that's probably the overarching question that a lot of people have, and maybe why we see so much uncertainty, at least in the precious metals sector. The people aren't sure which way the market is headed. I think first and foremost, you probably want to define inflation or define what the cause is. And is it monetary based? Meaning, are we seeing inflation because of low interest rates and money printing? Or is it caused by the COVID-19 pandemic and lockdowns? And for me, I think it's a little bit of both. I think if you look at the different sectors, you can pick out the points that say, okay, this is 100% monetary in nature. I think if you look at real estate, low interest rates, essentially free money, definitely has spurred more people to take on more risk and larger mortgages. And the COVID-19 pandemic, I think, definitely didn't help. People were locked down in their houses. Space became a premium. And so they wanted to, create entertainment rooms, redo their kitchens, these sort of things. And really that hit home and increasing home value prices, and also spurring this crazy contagion of real estate. So I live about 2 hours east of Toronto, out in the country. Essentially, there's no jobs out here. It's a tourist spot, yet home prices went up, or they doubled, essentially. So, to me, that's crazy. But it just shows you what people were valuing. And to me, it shows that, money is cheap. And to me, so that's at least more monetary than it is COVID-19 caused. On the flip side, when it comes to food or some of the lumber or manufacturing goods, semiconductors, I think COVID-19 pandemic is probably the primary reason why we've seen inflation in the prices of those products. The lockdowns, meat packing plants, we saw this in Canada, and I believe in the States too. They had outbreaks, supply shut down. And this is kind of what constrained the supply of these goods. Secondly, when you go further with the COVID-19 lockdown kind of strategy that they had, you had U.S. car manufacturers, who had to deal with the pandemic, but then they also were forced to make ventilators. And so the new car supply was constrained, and then you saw this huge push. Personally, I was looking at buying a truck, and I was looking at new and used, depending on, what was going to happen. And I was tracking a few used trucks, and I saw the price jump. And this is over the course of a couple of months. The alerts on price changes weren't going down, they were going up. And it's really indicative of that market. And I think is, directly related to COVID-19. So what I would say is this, I don't know what we're going to see. It's really hard to predict markets. I think that there's a portion of each. And I think that, or I would say that if you think that a large portion of prices were affected by COVID-19, that at some point in the future, you might see those retract once supply chains reestablish themselves, and, we're out of this pandemic or lockdown scenario, and things can kind of normalize. The other side to that is, there is a monetary component, and, that's going to be tough to adjust to, because if we see a drop in home prices or a rise in interest rates, a lot of people are going to be having problems. So in the end, I think Von Mies is right. There's the fear to spend, and there's the fear to save, and that will be ultimately what drives prices. And so, you be the judge of what we'll see most people do in the future, where they fear to spend their money because they think the future is going to be worse, or do they have a fear to save, meaning they only see prices rising, and thus they'll try to front run the price rises and buy up as much as they can. I'm really not sure what we're going to see. And it also depends on your timeline. In the short term or the long term, either could be right. So.
Absolutely. So Brian, do you think the Federal Reserve Bank is trapped when it comes to dealing with inflation and debt? How do the central banks resolve this issue in terms of monetary policy?
That's a great question. I do think they're trapped. And that's why I really look at any of the FOMC or Fed announcements sort of as satire. They'll try to talk the market either way, but I really don't think they've got anything left. Just in saying that, though, honestly, if you would have talked to me 5 or 6 years ago or 10 years ago, I would have said that, basically the same thing. Oh, they can't go on any further. they've kicked the can down the road a long ways. And who's to say that they can't do that for a while longer? I think the fact that COVID is still around, and a lot of the narrative surrounds further lockdowns, or the pandemic not ending anytime soon. I think that puts a big wrench into their plans, which to me means that I think that the unanswered question needs to be answered sooner than later. And the system's going to need an overhaul, and how and when that happens, I don't know. I've got some theories myself, but it's sort of meaningless. But yeah, I think their hands are tied. They can't really do much. And a 0.25% raise in interest rates, if that's what we're going to see as a form of tapering, so what? I get that really isn't the big difference. Are we going to see interest rates go back to even 4 or 5%? No, it's just not going to happen. So yeah, their hands are tied. They've got no way out. They can still push this further, but my guess is that we're going to see in the next year or so the actual answer to how they're going to reset the system.
Going to my next question, Brian, is there good public awareness about inflation and labor pressures among the general public? Does this affect investing sentiment?
I would say, generally speaking, outside of this year, I would say no, and people have no clue what inflation is. I would say it's akin to the silent killer, and the general public has no idea. However, you look at the last year, I would say 100% people see the cost of living rising. Everybody's visiting the grocery store, and it's probably the best way to gauge prices. You don't need CPI. CPI is a flawed number in my view. You just go to the grocery store and see what your bill is, and if anybody keeps track of it week to week or month to month, you'll see that it's invariably gone up, especially if you buy meat or beef, even more so. The cost of living has gone up greatly. So yeah, I would say the public is aware of it, but I'm not sure they know exactly what it is and what's happening and what might be the cause. And unfortunately, that's one of the big downfalls of society, where finance is probably one of the biggest parts of anybody's life. If you look at it, like I said, your home is usually your biggest investment over the course of your life, your biggest purchase. Next to that, it's somebody's retirement fund, which I guarantee you for 90% of the people out there is linked to the stock market, yet they know nothing about it. And this is a huge downfall in education, and I think is a big reason why we have all the problems we do. I think most people listen to the government promising, $5,000 here, $2,000 here. This is free, that's free. I think there's a huge disconnect into, where the government gets its money from and how it deploys it, and then how it also, creates money out of thin air. These are real problems, and the general public really doesn't seem to pay heed to it. It's a weird attitude that I see anyways, this entitlement towards something that's not even real. And this kind of where it's led us, and it has really hurt people more than helped them, even though it's always sold as something that's helping the general person, which it's not. Inflation destroys savings, and it makes the cost of living higher for everybody. And the rich already have a ton of money. It's not making a difference. A $50 steak or $100 steak. The people on the high end, the top 1%, the cost of a steak makes no difference. It's the middle class who gets knocked down because of this, and the poor have no money to begin with. So the poor don't see it either. And that erosion of the middle class is what's going to be a problem, at least in the Western world, moving forward. And it's primarily linked to inflation.
Absolutely. And you know what? You brought a lot of great examples there, Brian. And it's funny, I even saw on Twitter like the other day about Uber and Lyft saying that, their prices have gone up almost a double, up 95%, right? So it's just showing just everywhere, business are increasing their prices, whether it's in the grocery store or whether it's an app like Uber. So this leads me now to my next question, which is, now that inflation is starting to come up more clear to some people, we know that precious metals is a great way to protect wealth. So do you think gold and silver mining stocks are currently undervalued right now?
It's a good question. It's hard to answer. It depends on it's always perspective, right? For me, as a resource sector investor, 100% they're undervalued. to how I go through my process. But don't forget that any company that isn't cash flowing, really, when you talk about value, it's not 100% thing. There's still an abstract portion to that, right? Because ounces in the ground need to be, they need to be mined, that you need to process those minerals to extract the metals, and then you need to refine them. So there's a lot that goes into it. So when you talk about junior companies that aren't cash flowing, much of it is sort of abstract. With that said, I think that you can form a valuation thesis for companies with resources, and some have economic studies. And when you compare them to the value of what they would be if they were a mine, absolutely, at these gold prices, the stocks are as cheap as they've been in years. And really, it is an opportunity for people that are looking to, make some money in the market. One thing I'll say though, there's a big difference between buying metals and buying, junior resource companies. In my view, you buy precious metals as insurance against, financial calamity. And that's kind of what we're seeing in the world. I really don't look forward to making money off my physical metal. A gold price going to $5,000 means that the world is in trouble, and all the other aspects of my life are probably in sort of disarray. Meaning, I'm buying, going back to the food example, my grocery bill on a weekly basis has gone from $100 to $200 or $300, and I see the reflection in the gold, and it's the reason why I own it. But really, the rest of life looks pretty dismal in a lot of ways. With that said, the other side to it is a $5,000 gold price. It'll do wonders for the portfolio, and that's the other aspect to it. But don't forget, these junior companies are really speculations on people and people's ability to execute on action plans and get market recognition for the underlying value that they've created. If people don't execute, you're not going to see that value recognized, even if the thing is selling for less than it's worth. You need them to be able to execute. And that's why you'll hear, any market pundit or anybody who's been investing in the junior resource sector long enough, it's people, people, people. And you get the people right, and you put yourself in a much better position to get your profits or your speculation right at the end of the day.
So Brian, you have a lot of experience, which is why I have you on like the show today about resource stocks, but most importantly in the junior sector. You have written a free ebook called Junior Resource Sector Investing: The Risks, the Rules, and the Strategies You Need to Know. What are some key takeaways that people should pay close attention to who don't know much about the resource sector or are starting to learn more about it? What are your biggest key takeaways?
Sure. So let's start with the risks first. I think that one of the first things that people need to recognize is that, like I said, that resource companies are speculations on people's ability to execute. That's the biggest portion. The other side to that is there's a varying spectrum of risk. Meaning, if you go with the smallest companies, the exploration companies that essentially have nothing, they're looking to make a discovery of gold or nickel or whatever type of metal it is. Those exploration companies come with the highest amount of risk because they don't have anything. And their valuation is primarily based off the intellectual capital that the company has. So when you form a value or make an investment thesis on an exploration company, it's almost solely based on the people and probably partially the geological potential of their project. So, if you're going to invest in exploration companies, because the people and the project mean so much more, obviously your intelligence or your technical acumen have to be that much higher from a geological perspective. For you to be able to say this is the value of this company, you obviously need to have that kind of background, I think anyways, to make a reasonable decision. You have developers who are kind of your mid-risk range. They've outlined a resource. In some cases, they have some sort of technical study or economic study on the project. And they come with like a mixed bag of risk, where sometimes the project isn't good enough in its position. Maybe it's not big enough to be put into production or justify a big capex. And the management team is working towards making the deposit bigger. And therefore your risks, you've got some downside risk protection in the fact that there's an existing deposit. But the management team is going to have to do some work to make it better. And so there's that nice balance. And really that's mostly where I live, is in the developer stage, something that has a resource. And then if you move further out to the lower end of the risk pyramid, you have the producers, and then finally the royalty companies and streamers. And here, to me, in my view, there is less risk. These are producing companies. They're in most cases cash flow positive, especially at these gold prices. If they're not cash flow positive, I would run for the door. But it's going to come down to how you analyze that balance sheet. And to me, I think more of the generalist investor, or especially the newbie to the resource sector, this is probably where you want to start, because you basically have to analyze the balance sheet, which I think in terms of skills to acquire, I think it's much easier to learn the basics about balance sheets than the basics about geology. And the risk is much less based on your decision when you deal with producers. So that's what I was talking about with the risks. Then when it comes to strategies, for me, I have developed a process over the last 5 or 6 years, and it's really been refined. One of the things that is sort of innate to me is, I'm an engineer by trade. I'm analytical. And I also come and see the benefits of standardization. In steel manufacturing, process controls and, process standardization is key. So you can insert new operators into the process and you shouldn't skip a beat. If you've got a certain table height on a conveyor, for the different products, you standardize what that table height is, and you don't have any messing around. So you reduce downtime and such. So that's standardization. And I just paralleled that to my investing career. And I wanted to say, okay, I want to standardize my approach to how I invest in the market. And the first iteration of that was a set of rules. I literally capped a piece of paper beside my desk, and it had, I think usually it was around 15 rules. And the rules, what I wanted to do is anytime I wanted to make a decision on a company or anything I was doing in the sector, I had to go through these rules and I had to meet the criteria that I set out every single time. And for me, that was somewhat of a fail-safe of saying, this is how I protect my downside. And, that you'll learn that, protecting your downside is the first and foremost thing you need to do. Also, the rules that I had have progressively gotten better. You'll tend to have pretty loose rules to start, or maybe rules that aren't going to protect your downside as much, but you have to learn with the process and analyze your failures and invariably create a very tight list of criteria that you need to meet before you'll put your money into the market. So basically I wrote that ebook with those things in mind. And I think if investors can start to apply it, you're not going to be perfect first to start, but over the course of let's say your 10,000 hours, that list is going to get a lot better, and you'll get to the point where I am, where I have far more winners than losers. And I still make mistakes, and I'm still learning. It never stops. But that represents the baseline of how I invest in the market, and 100% is a big reason why I've been successful.
I'm going to make sure, by the way, for the listeners who are listening, I will make sure to put a link for where you could go to get access to that ebook. So thanks, Brian, for talking about that. So Brian, as a writer, you recommend which junior resource companies to invest in. How do you go about researching and picking companies to recommend to investors? Why should we be confident that you are recommending the right basket of companies to invest in?
That's a good question. For me, I think it's going to range. There's a ton of different ways to make money in the market, and everybody will need to come up with their own process. For me, I listen to just about any company that wants to pitch me. Excuse me. And that's not going to work for everybody, but I want to listen to all the stories, and then I put it across my criteria, and I say no more often than not. I'm looking for the price to value ratio to guide the way I invest in the market and deploy. Now, that's a very simplistic way of looking at it, but it is sort of that simple. But of course, how you analyze that price to value ratio with all the other factors, and this, bringing to the people, the project, the jurisdiction, the share structure, the potential, the catalyst, the timing, where you are in the cycle, all these different things kind of play in to how that price to value ratio sort of dictates how you work. And that's how I operate. Now, I've been able to leave my job. Like I said, 5 years ago, I've been able to support my family through, decisions I've been making with investing. And I think the proof is in the pudding, as they say. If I've been able to do that, I think that speaks to my ability and my process actually working. With that said, I'm not infallible. I do make mistakes 100%. And whether you believe or don't believe the reasons for my success, that's up to you. But, I do have a process, and it's, primarily guided by the price to value ratio. And, where I am today in life is proof that my process works. And that's what I show in my newsletter. And I've got a string of wins. And, over last year, I think it was 11 or 12 companies that I recommended, and the average return was around 160%. But don't forget, that's an average. So there's some losers in there, but there are some big winners. And, there's one company in particular that definitely raised that average a bit. But to me, that shows really good stock picking skill. And yeah, that's where I am today.
Awesome. Thanks, Brian. Thanks for sharing that success too, just because the last year has been quite the pullback there for gold and silver. And so that's definitely impressive for sure. So Brian, going to my next question, there's been a lot of attention recently about Newfoundland. And in a recent interview with Investing News, I believe it was with Charlotte, you spoke about the next hot area play will be in Northern Ontario. Why is this?
It's just a view I have, and I think so. The Newfoundland craze is a mixture of a fantastic discovery and great promotion. They made the discovery, and then not only the company that made the discovery, but all the other companies in the area were able to get out in front of the market and say, "Look at us," and really created this craze in Newfoundland, where you still see valuations quite high compared to other places. My premise with the Birch-Uchi subprovince in Northern Ontario, which is right around Red Lake, is there's one company in particular that I think has the chance to make a very impactful discovery. Doing my research, a few months ago, I think that their golden till anomaly is, one of the best I've ever seen. That doesn't mean that they're going to make the discovery, but I think if they do, it's going to attract a lot of attention to the area. And much like Newfoundland, I think there's that snowball effect where you see other companies rush in, a staking rush, and try to grab up land around potentially this company to get proximity to what could be a big gold discovery. The other thing about the Birch-Uchi, I think it's one of the only remaining areas in that whole Northern Ontario, Quebec, Abitibi area that hasn't been touched. And the reason why it hasn't really been touched is because it's undercover. The bedrock isn't exposed at surface. You don't have these outcropping deposits. All those good deposits that were outcropping have probably mostly been found. Birch-Uchi, you have a significant layer of glacial till or overburden, and these companies are going to have to find these blind deposits using golden till sampling, really good geological mapping, putting their geological acumen to the test. And I think there's a couple of companies. There's one in the junior structured premium portfolio that just took a 60,000 hectare position in the Birch-Uchi. And if you talk to them, they'll tell you that this is exactly why that they've done that. And they've got a set process for delineating and reducing that land position and focus in on where they might be able to make a discovery. So yeah, my thesis for that, and I wouldn't invest in there just because of that. But I think there's a potential for a really good discovery to be made. And then from that, a staking rush to be in that area.
Thanks, Brian, for sharing your thesis and explaining that. It wasn't until I heard that interview that I had heard about that specific area. So, Brian, what separates a good junior company from a great junior company? Because there's so many out there.
Yeah. So I wouldn't even say good and great. It's probably like mediocre and great because I think there's just a lot of companies that they're good. Like, well, actually, maybe you're right. They're just good. They've got some potential. The management team is good. They may not have the track record. They may not have the access to cash, but it's all those things that make the company great. And, first it's the people. When you can find people that have been successful before, they've made a discovery or they've, built a mine, they built multiple mines. I actually just recommended a company this morning. And I had no idea up until the last couple of weeks. I'd never heard of them, but they're one of the best known mine builders in the world. They've been sought out by, a number of well-known senior mining companies and mining groups to build their mines. And if you looked at their list, you'd say, wow, I know that mine and these guys built it. And they've started a company. They've gone from a technical services firm to a junior company, and they're going to mine build. When you find, companies that are built on the past success of the people running it, I think you put yourself in a really good position to be successful. If you listen to guys like Rick Rule, it's exactly what he'll tell you. He's like, don't even mess around with the probability of necessarily somebody new. Look at the people that have done it before, and these guys are serially successful. And I can't argue with that. If you look at what he's telling you, and you look at those people in the market, these guys find a way. If you find those good people, they find the good projects. And if that project they select isn't good, they get rid of it and they go to the next one. If people are patient, I think that, that's a really good way to be in the market. So the baseline is this: good people, access to cash, that have good projects. And depending on what that project is, where it is, if it's exploration, development, or of course, producing, the better you can get to world-class, or the closer you can get to world-class, is where you want to be. Exploration, you want to see big targets, big geochemical targets. And if they coincide with the geophysics, that's fantastic. Look for that size, because again, another Rick Roll quote, but you don't want to mess around with the small stuff. You want to stick to the big stuff, because both have the same amount of risk, but only the big stuff can make you big money. And I think it's absolutely true. And then again, it's just a sliding spectrum with the developers. Again, you want to find the best of best projects, good grade, or most importantly, really good economics. They can handle the gold price falling back to 1,200 if that did happen, and still make you money. And the same with the producers. You find the producers that give you the most value and are trading at the most discount. And again, a blend of the other factors, including the people. So yeah, that's the basis of it.
Okay, great. So Brian, which commodities are you most bullish on this year? What is your top investment idea for year end?
I'm really drawn to the precious metals. I think that from a number of factors, first and foremost, kind of how we started our conversation, I think the most value is found in the precious metals companies. They've come off a huge amount from their highs from last year, and the gold price has actually remained quite steady at $1,800. Like, people forget that up until last year, the highest gold price we ever saw was 1920. So, at $1,800, it's quite high. And, the gold producers and royalty companies are making a lot of money. So first and foremost, that's where I see the most value. The other side to that is I also see, well, it'll be interesting to see how the next 6 months to a year is kind of play out. It could be very interesting. And I think in either scenario, inflation or deflation, I think gold is where you want to be. In the inflationary scenario, dollars, mainly US dollars, lose their value in relation to real assets, therefore good for gold. In the deflationary setting, dollars increase in value, which on the face is bad for gold. But don't forget that there's a huge amount of debt in the system. The central banks and governments can't afford their dollars to gain in value when they have debt levels like they do. Debt will be staved off, in my view, at all costs. You will see further QE. You might see negative interest rates, And it's actually kind of mind blowing if you actually think about what that, if we actually did see banks, you know, make us pay to keep our money in the bank. Like it doesn't even make any sense. It's hard for me to compute. But those factors, lead me to believe that precious metals are going to be where you want to be in the next 6 months to a year. And given where their valuations are, it's like the perfect scenario for profits to potentially be made. So that's where I would look and let the price to value ratio guide you into which company best fits your risk profile, whether that's a producer, a developer, or an exploration company.
Absolutely. So, Brian, leading to my next question, who are your greatest mentors? Where do you suggest that millennial investors go to better educate themselves before making any investment decisions?
That's a great question. I think that mentors, without a doubt, have made a huge impact on my life. For me, it started with Doug Casey. I'd never really heard anybody talk about gold or silver or monetary policy. And I just before I married my wife, I met her brother, and he had flown in from the West Coast, and we were talking, and he started talking about this guy Doug Casey and gold and silver, and it was a great conversation. But after it, I was left to myself. I was like, wow, you know what? I have no idea what this guy's talking about, and he seems intelligent. So this is probably something I need to look at. And I went down the rabbit hole, and I've learned a ton, and it really opened my eyes to the world and basically where I fit into it. I had no idea what a libertarian was before Doug Casey. And, learning about myself, it's that, again, that's something innate to me, that I'm libertarian to the heart. And that really, opened my eyes to where I fit in. From there, invariably, Doug Casey led me to Rick Rule. And Rick Rule, of course, I think he knows who I am now. I've talked to him, a lot, done the interviews and stuff like that. But of course, 10 years ago, he had no idea who I was. I'd never met him before. But again, I think with my personality, I took a lot from what he said in his interviews. And I think people focus too much on meaning what to invest in, what company or what metal. Don't even bother with that. Don't bother with that. Any commentator. Listen to the how, listen to the why. How and why are they doing what they're doing? If you can wrap your head around and focus in on those two aspects of it, you'll be way ahead of the rest of the people. And really, that's all you really need to do, is just be ahead of the average investor out there to really make money, in my view. And again, do not be worried about the what. You will figure that out soon enough. You need to first concentrate on the how and the why, and moving that forward will be a big part of it. And then last, or not last, there's definitely other people, but another person that's made a huge impact on me is Giant Bhandari, both from a mentor and a friendship aspect. Quite honestly, in the last 3 or 4 years, nobody's made a bigger impact on me, and I'm grateful for the knowledge and experience that he's bestowed. And I'm thankful for myself for listening. Get rid of the ego and listen to people that have done it before. And we were talking just before we got on camera here about the impact of learning how to sell. And there's always a sell price. No matter how good the company is, there's always a price where I think you need to sell. And that realization, while you probably have it in your head, and I did, but I wasn't putting it into practice like I should. And that's one aspect where Giant was integral to my success and really changed and made me progress from an investor standpoint. So from that perspective, I've been truly grateful. And he's someone that has a free newsletter himself, and I think would be someone that you need to listen to. You can hear his presentations and stuff like that. His information is invaluable.
Yeah, thanks, Brian, for taking the time there to share 3 of your mentors. I'm so happy to hear, and I mean it authentically, that they've had such an impact on your life. and not only on your life, but even on your mindset that now you are sharing with others. So that's awesome. That's beautiful. As you know, the purpose of this podcast is to inspire people to achieve greatness and enhance their overall personal well-being. So what is your definition of greatness?
It's a good question. I would say this. I would say that greatness has got to be linked to you reaching or attaining whatever your best form of self is. And I mean that from a mental and physical standpoint. You probably can separate the both of them. But being the best you would be as great as it can be. And I think too many people want to compare themselves to other people and how well they've done at this or that and come up with explanations of why they've done well and I haven't. But there'll always be someone that's better than you. All you can ever do is look for, I think anyways, partial improvement every day. And it can be small, but just pushing towards that greatest form of you. And that's all you can ever expect out of yourself. And, you should be, I don't know if anybody ever really attains full greatness, to be honest with you. I think there's always stuff that you're trying to get better at and trying to fully learn who you are. But as you get closer to that, I think success 100% comes with it. And like I said, if you would have asked me 10, 15 years ago, would I be here today talking to you about success and investing? I would have said, no way. Like I never saw this path to my life. But now, quite honestly, with what I've learned about myself and kind of where I fit in, this is absolutely where I should be. And I 100% am still learning and still striving to be better. But this fits me to a T, my personality and what I've learned about myself. And again, I think that's all you can actually ever look for. And that's what I would say.
Awesome. Thanks for sharing that, Brian. I definitely think that's a good perspective, essentially being the best that you can be every day. We say it a lot in like the fitness world, but you're only competing against yourself, right?
Yeah.
So being the best you and always competing against your PRs and continuing to get better. So that's awesome. Who is a future guest that you would like to see on this show?
It's somebody, again, that I mentioned just earlier, but Giant Bhandari, in my view, is an influence that we need more of in this world, both from a libertarian perspective and investing perspective. I'm telling you, like, I've learned so much from him, and he's got a free newsletter, which he offers it up to the public for free. And I think if you listen to him, some people may not always agree with what he has to say, but I guarantee you that there's something to always be learned. So he's somebody that I would suggest that you talk to and learn from.
Well, I will do my best to bring him on one day, and I'll definitely make sure to let you know when that day comes. Mm-hmm. Where can our listeners go to connect with you online?
So juniorstockreview.com is the main website. The newsletter is Junior Stock Review Premium. So Junior Stock Review Premium or / premium subscription, and they can learn all about the subscription and what it offers. Alternatively, if you want to send me an email with any questions you have, please do so. And that's at juniorstockreview@gmail.com, and be happy to hear from you.
Awesome, Brian. So I will make sure to put that in the podcast notes. Once again, Brian, I want to take the moment to really thank you for being here. Thank you for your time. I know it's a big appreciation to myself as well as my listeners. And I look forward to having you on again.
Oh, thank you very much, Ben. It was a great conversation. I really enjoyed it.
This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal advice is needed, consult a qualified legal, tax, or investment professional. Do not base any investment decision on the information contained on Living Your Greatness or our videos. Thank you for listening to the Living Your Greatness podcast. If this show has added value, please subscribe, leave a rating, and make a review.